Welcome to Module 1, Engagement Planning, Obtaining an Understanding of the Client, and Assessing Risks. Today, we will deal with basic concepts, financial statement assertions. So if you're ready, let's dive in. Every number in the financial statements is a promise, a silent claim made by management. Today, we uncover these promises because as auditors, we don't just check numbers, we verify trust. Assertions act like a bridge. Management prepares the financial statements and makes claims, sometimes explicit, often implied. Our job is to test whether these claims hold up. Remember, management is responsible for the fair presentation of financial statements. Assertions are grouped into three categories. Transactions tell the story of what happened. Account balances tell us what exists today. And disclosures tell us how the story is presented. Every transaction recorded in the books is an event that management claims occurred. Our task as auditor is to confirm it really did, that nothing is missing, and that timing, amounts, and classifications are all correct. Occurrence asks a simple but powerful question. Did this really happen? So fraudsters love inflating revenue. So occurrence is one of the auditor's first defenses. So if you look at this slide, it says here the definition of occurrence. Transactions recorded actually occurred. The risk is fictitious sales, ghost expenses, invalid transactions. Example, a client books 10 million in sales on December 31st, but no delivery was made. The next one is transaction classes. Completeness, assertion. So the definition is all transactions that should be recorded are actually included. The risk involved, unrecorded liabilities, understated expenses. So completeness is about what's missing. Companies rarely forget revenue, but liabilities, well, that's another story. So let's take a look at this example. Goods worth 1 million were delivered by the supplier before year end. But the receiving report was intentionally not processed, leaving the purchase unrecorded. So what is the usual entry for this? Debit purchases or materials, inventory, or expenses. And the credit is usually accounts payable. So if we omit this transaction, it will result to the understatement of accounts payable and expenses. Transaction classes accuracy. Now let's go to this assertion accuracy. The definition says here, recorded amounts are correct. The risk here is that wrong rates, miscalculations, or wrong FX conversions. Example, interest expense miscomputed using 10% instead of 12%. So even when a transaction happened and recorded, it might still be wrong. Accuracy ensures the numbers reflect reality, not clerical errors. Now let's move on to the next assertion, which is cutoff. The definition here says transactions recorded in the correct accounting period. Risk, shifting revenue or expenses to manipulate the profit. What is usually the cutoff period? In the Philippines, normally, the period is January 1 to December 31. We call it calendar year. Some companies follow the fiscal year, especially if their mother company are also using the fiscal year. Like for example, February 1 to January 31, so 12 months from that date. Okay, let's take a look at this example. Recording January sales in December to meet targets. A sale of 500,000 was made on January 3, but management prematurely recorded it on December 31 to boost the year-end revenue. So the incorrect journal here that was posted on December 31 is debit accounts receivable of 500,000 and credit sales revenue. So the cutoff is the timekeeper of the audit. So one day too early or one day too late, and the financial story becomes distorted. Okay, let's take a look at the next slide. No? So remember this entry, a debit to 500,000 and a credit to sales revenue of 500,000. Let's go to the next slide. Okay. If we do the T accounts for the incorrect cutoff, so look at this one. You will have a sales revenue of 500,000 and you will have an accounts receivable of 500,000. So the effect here is that you have an overstated sales revenue, an overstated accounts receivable. You also have, because you have an overstated revenue, then you have an overstated net income. So the users, the investors or creditors or the users of the financial statement think that performance improved when actually it didn't. So the correct entry for this should be a debit to AR. It's the same. Debit to AR and a credit to revenue for 500,000, but it should be booked in January of the following year. Okay, moving on to the next slide. The assertion here is classification. The definition is transactions recorded in the correct accounts. The risk is misclassifying operating expenses as an asset. So it says here, classification prevents financial statements from being dressed up. Statements from being dressed up. Sorry, a repair cannot magically become an asset, at least not on our watch. So let's take a look at this example. The company spent 120,000 on repairs and maintenance for machinery. Management incorrectly capitalized it as machinery to avoid recognizing an expense. So on December 15, the accountant has booked a debit to machinery and a credit to cash for 120,000. Okay, take a look at the T account on the next slide. All right, so if you look at the T account, you have a debit there, an increase there of 120,000. And also in repairs and maintenance, there's nothing. And the cash, a credit of 120,000. So if you look at all these T accounts, only the machinery and repairs and maintenance are incorrect. Cash is already correct. Okay. So what are the effects? The effect of this entry has resulted to assets overstated, expenses understated, net income is also overstated because you didn't put any expenses, and your equity is overstated. Okay, the correct entry for this should be a debit to repairs and expenses and a credit to cash. So finally, please remember this. Classification errors don't change total debits and credits, but they distort the story of the financial statements. An expense disguised as an asset makes the company look more profitable than it really is because you're basically delaying it. Even if you put that in the asset, classified as an asset, you still have to depreciate that. But instead of putting it 100% on expense account, let's say you depreciate that for 5 years, then you only get 20%. You only record 20% to the expense in the form of depreciation. As auditors, we must ensure every transaction lives in the right category. Okay, moving on to the next assertion for account balances. Okay. Balances tell us what the company owns and owes. Now, we're not just verifying events, we are verifying reality. So we're going to have to look at the existence, rights and obligations, completeness, valuation, and allocation. So let's start with existence. So it says here that the definition is assets and liabilities exist at the reporting date. The risk, inflated inventory, and fake receivables. So example here, inventory listed in Cebu warehouse, but the warehouse is actually empty. So existence protects the financials from illusion. An asset on paper must be an asset in real life. Now let's go to the next assertion, as rights and obligations. It says here that the definition is entity holds or controls the right to assets, and liabilities are the obligations of the entity. The risk here is that goods held on consignment recorded as owned. Let's take a look at this example. Inventory borrowed temporarily just to look good during audit. So even if something exists, it may not belong to the client. So ownership matters. When companies hide liabilities, they rarely leave the books unbalanced. Instead, they bury the credit somewhere it doesn't belong, often as an income. Okay, let's take a look at the definition. All assets and especially liabilities that should be recorded are included at the reporting date. Example, loan payables not recorded to hide debt. Let's take a look at this scenario. On December 20, the company receives 2.5 million in loan proceeds from a bank. So management wants to hide the liability to avoid breaching debt covenants. The incorrect entry posted was a debit to cash and a credit to miscellaneous income. So this hides the liability and inflates the profit. Books remain balanced, but financial statements are materially misstatements. So the cash here goes up, income goes up, and the loan payable disappears. The books balance, but the financial statements lie. Okay, now let's go to valuation and allocation. The definition here says balances recorded at proper amounts. Risk, overvalued receivables, obsolete inventory not written down. An example, a customer owing 5 million hasn't paid in 3 years, but still shown as collectible. So even when a transaction happened and is recorded, it might still be wrong. Accuracy ensures the numbers reflect reality, not clerical errors. Okay, so the picture here says it all. You have an inventory, but it's not the real value of your inventory. It should be depreciated. No? So let's go to the presentation and disclosure assertion. We'll talk briefly about assertions for presentation and disclosure. This includes occurrence, rights and obligations, completeness, classification, accuracy, and valuation. So why assertions drive audit procedures? If you think about it, every financial statement is a set of promises. Management is saying these sales happened, these assets exist, these liabilities are complete, these amounts are accurate. So assertions take those promises from the management and turn them into audit questions. Is something missing? Is something fake? Is something overstated? And so once we know the question, the audit procedure becomes obvious. If the risk is fake receivables, confirm them. So if the risk is unrecorded liabilities, search for them. If the risk is wrong valuation, recalculate. Assertions stop us from doing random checklists. They make the audit focused, intelligent, and complete. Assertions don't just guide the audit, they drive it. Let's take a look at this case, illustration of XYZ trading. So it says here XYZ claims 50 million in receivables. Now, see what's the red flag here. It says sudden spike in December sales. So assertions help us zoom in. A single spike leads us to ask, did these sales occur? Do they exist? Are they real? Can they be collected? So these questions are important for auditor to check and find out. For our summary, to summarize, okay, here are the 5 core promises. If you look at these boxes, it says here transactions, balances, disclosures, is anything missing, accuracy, and valuation. So for the transactions, always ask questions like what happened. Balances, you ask question like what exists. How is it presented for disclosure? And is anything missing for the completeness? Accuracy and valuation, we ask question like is the amount correct? So this is going to guide you as auditor on where you're going to drive your audit. All right, now we're done. We have just finished the review of Module 1.A, Basic Concepts. Topic is Financial Statement Assertions. It's a bit longer than I thought, but I think it's worth it. So now let's try to answer some CPALIT type questions. If you're ready, now let's begin. Question number 1. The assertion that recorded transactions actually took place is A. Completeness, B. Occurrence, C. Rights and obligations, and D. Accuracy. You may pause this video to think. Okay, for question number 1, the correct answer is letter B, occurrence. Occurrence ensures recorded transactions are real. Now let's go to question number 2. Failure to record accrued expenses violates which assertion? A. Completeness, B. Existence, C. Classification, and D. Cutoff. The correct answer is completeness. If something should be recorded but is missing, completeness is violated. Moving on to question number 3. An auditor inspects warehouse inventory to confirm it physically exists. Which assertion? A. Accuracy, B. Existence, C. Rights and obligations, and D. Cutoff. You may pause this video to think. The correct answer is letter B, existence. Existence deals with whether assets actually exist. Now let's move on to question number 4. Management recorded consigned goods as inventory. Which assertion is violated? A. Rights and obligations, B. Classification, C. Accuracy, and D. Completeness. You may pause this video to think. The correct answer is letter A, rights and obligations. So client does not own consigned goods. Moving on to question number 5, testing depreciation. Calculations primarily relates to A. Cutoff, B. Valuation and allocation, C. Existence, and letter D. Occurrence. You may pause this video to think. The correct answer is letter B, valuation and allocation. Depreciation evaluates whether asset balances are properly valued. Okay, question number 6. Recording January revenue in December violates A. Completeness, B. Classification, C. Cutoff, and D. Accuracy. You may pause this video to think. The correct answer is letter C, cutoff. Cutoff concerns timing of transactions. Okay, moving on to question 7. Comparing AR aging to determine collectibility tests which assertion? A. Existence, B. Occurrence, C. Valuation, and D. Rights. You may pause this video to think. The correct answer is letter C, valuation. Aging evaluates whether receivables are valued correctly. Okay, that's all. Congratulations, you've completed another module, audit financial statement assertion. So keep studying diligently. Remember that continuous learning is key in this profession. So if you found this video helpful, please give it a thumbs up, share it with your fellow students, and subscribe to our channel for more valuable content on accounting and auditing. So your support helps us create more resources like this. Thank you so much.